Good evening. We're getting more data that adds further pieces of the jigsaw onto what's happening in the US economy. Today it was jobs, where we learned that American employers added 177,000 jobs in April, which was more than economists had expected. That was optimistic for the markets, and the S&P 500, as you saw, closed higher for the ninth session in a row. What that means is it's erased all the losses following Liberation Day and the announcement of tariffs a month ago. The jobs numbers also added context to that GDP that we saw on Wednesday, which showed a slight contraction in Q1. Aditya Bhave is a senior U.S. economist at Bank of America and joins me now. Glad to have you with us. What do you make of those numbers? We've had two important pieces, one more backward looking than both backward looking, but we've also had other data that shows. What do you make of them?
Good evening. Thank you for having me on. I think the U.S. economy is on solid footing. Starting with the jobs report, the two most important numbers, you mentioned 177,000 jobs added. That was above expectations. And then also the unemployment rate, very importantly, remained stable at 4.2%, which is very much consistent with where the Fed thinks kind of full employment in the economy is. On the GDP number, not really concerned about the negative 0.3%. There were some distortions around the imports data. What you should really focus on is final private demand. That was up 3%.
Okay, so at what point, if at all, do you think that we are going to see effects of tariffs? Because the tariff headwinds, 20, 25% for this or that, 10% general, 145%, that is happening now. And we've seen from sentiment and consumer data the weakness and worry. So when do we start to see that coming through in hard data?
I think at the earliest, you'll see it in the May data, more likely June, July, and thereafter. We've built in a little bit of softness in the economy in the second and third quarters of this year. The idea would be that CapEx slows down as businesses are a little bit frozen because of trade-related uncertainty, but we don't have a recession. We think the economy can muddle through, largely because we expect the labor market to hold on, and that should generate enough income for consumers to keep spending.
When you say you don't expect a recession, I mean, that's taking a classic definition of 2 quarters of negative GDP. But you do expect a slowdown, don't you? And you do expect us to sort of be bouncing around that level.
We expect weaker economic growth. That's not saying a lot, to be honest, because for the last couple of years, we've been growing at 3%. So our growth forecast for the full year is 1%. For the second and third quarters, we're looking for weaker final demand than even that. So we'll get close to a recession in our view, but we see about a 1 in 3 chance of a recession. So it's not the base case, it's a risk, and growth should slow down going forward.
On this program, on Question Means Business, we often talk about this. And, you know, if you're a consumer or if you're in a household, there's very little difference, isn't there, between plus 0.5 and minus 0.5. We might get terribly excited at the prospect of a technical versus real recession. But this sluggish growth that we're going to see for the rest of this year, is it possible that trade deals executed by the administration reverse the economic scenario? Or is this a cake that's baked?
Some of it might be baked into the pie. I think that is more the uncertainty story, where at least in the near terms, businesses are going to be a little bit frozen until they get more clarity on the tariff story. The other thing that's probably baked into the pie is the fact that you'll get some payback in the second quarter because there was very aggressive front loading in certain business investment components in the first quarter, as well as certain parts of consumer spending. So that's baked into the pie. But in terms of trade deals, for sure, I mean, if the tariffs get negotiated away, then the economic outlook improves, particularly because we're also likely going to get a big fiscal bill, which will have some front-loaded stimulus in our view later this year.
And when that happens, you're talking about the tax cuts, of course, and the tax bill that we will get, and the budget, which we just saw, a trillion on security and defense. When that happens, do we all just ignore the deficit?
The deficit is more of a longer term concern, but it is something that we're concerned about, right? And I think it's showing up in the 30-year bond yield. So it's not that we need to get concerned in the future, it's that markets are already concerned about it. The 30-year yield has pushed 5% a few times. So clearly that is getting into focus. The question is, how much can tariff revenue pay for those tax cuts? If the tariffs get negotiated away, that's good news for the economic outlook, but then you don't have the revenue offset for the tax cuts that we will probably get.
We've much more to talk about over the months and weeks ahead. I'm grateful to you, sir. Have a good weekend. Whatever you have to manage to put all that tariffs to one side and have a gin and tonic instead. Thank you, sir.